Jesus.
S&P 500 program trade buy level 1.
This is your wake-up call, pal. Go to work.
Okay, so today we're talking about spreads, and it's a beginner's talk on spreads. I don't want to get too complex here because there's no real reason to. I want to cover a few basics and then point you in the right direction for more. Perhaps in another talk we'll talk about some complexities, but right now I don't think we really need to. Okay, so but first up, I want to read you part of an email I was sent earlier this week. It's by one of the guys currently doing a course on masterclasstrader.com. Right? He said, "Today has been a very interesting day for my training. I decided to concentrate on spreads, no outrights at all, and this is a real game changer. You were right, spreading is much worth the initial difficulties, and I do find it a bit more intense regarding use of grey cells, a big pun, which I really enjoy." Right? And I love that quote. I love it. Fantastic. It's the best thing that's been said to me for a long time, strangely. But it shows he's getting it, which is great. And the point, this is the point where things can start to change for traders when they start seeing those things as like, this is the way to go. Those are moments, in the prop trading world, almost all of us trade spreads. Same goes for hedge funds, right? There's few exceptions. Maybe long-term equity funds, that kind of things aren't spread traders, of course. But all that short-term swing traders, scalping, active trading, trading less than a year, that kind of thing, we all have spreads in our arsenal of things to trade. So they're very important to learn. I've never met, it's interesting, like in the prop trading world, I've never met someone who said, I used to trade spreads, I don't anymore, I've gone back to outrights. That just doesn't happen, right? And I think that really says something, that tells us that this is something we should be doing. So anyway, let's get on with it. Now, a few years ago, I had a PDF ebook download on one of my sites called Three Little Spreads Went to Market. I liked it because of the name. I thought it was a funny name. But it was also the most popular download, I think, for a while there on one of my sites. And it covered a few definitions, a few terms, plus the three basic spreads that you need to know that are the building blocks of all spread trades. So I thought we'd go through those three basic spreads and a little bit of jargon. Unfortunately, you need to know jargon. Doctors need to do it for their profession. Mechanics need to do it for their profession. For any profession, you need to know the jargon, and trading is no different. And spreading is no different. Spreading has its own jargon too. When I first started trading, or when more or less my trading first really started taking off, I was trading options. Now, no one trades options without trading spreads, and if they're losing money. It's one of those things where it's an integral part of trading options. And the same thing goes for futures. Right? There are plenty of outright futures traders, but as I said, in the prop world, not so much. But spreads can apply to futures just as much as they do options. In other markets too, foreign exchange is another spreading type market. In fact, if you think of it, any exchange rate is a spread. But that's another academic talk we'll talk about another time. So let's go through a few things. What exactly is a spread? What do I mean by spreading? It's essentially trading two correlated markets, generally with, this is a very general definition, but a spread involves buying one contract and selling the other with the idea of profiting from a changing the value between the two. Right? So if I'm buying something at 10 and selling short something at 8, that's a spread price of 2. If it goes to 4, then it's now worth 4. Okay. So in a way, a lot of spread trades aren't particularly directional. I'll talk about that in a second, directional spread trades, but they don't need to be directional. They generally need to be something that's correlated, even negatively correlated, that therefore you wouldn't be buying and selling, you'd be buying and buying if you're selling and selling. Again, another academic thing, but generally when we look at spreads, keeping it general, we're looking at two correlated markets and then we sell one, buy the other. You don't want a perfect correlation. We're not talking about things that move tick for tick together, otherwise where's the spread? But those imperfect correlations do create spread opportunities. So when we talk about spreads, let's go through a few definitions before we talk about actual strategies. You've got legs. Generally, one part of a spread is called a leg. Buy one leg, sell the other leg. We talk about, in futures, we talk about near month or front month, and we talk about the deferred month. Right, they're terms that are applicable to general futures trading, but we use them more in spreads. We talk about the differential, which is just the difference between the price of one instrument versus the next. Okay. We talk about, what's another one? Parity. We talk about parity when two instruments are the same price or zero. Some call it evens. Parity. I like parity for some reason. Maybe that was how I learnt. It was one of the first books I read on it, maybe. But other people call it evens. But that means zero. These are important, by the way. They are important because you will use them. Narrowing and widening, these are terms relating to where the spread price is moving relative to that parity level. So if a spread price is plus 10 and it goes to plus 12, it widens. If it's minus 10 and goes to minus 12, it also widens. So it's moving away from that zero line. So narrowing is when it moves towards the zero line, if that makes sense. It's generally, those things aren't generally important unless the market's trading close to that zero line, which can happen in things like, happen in plenty of contracts. Euro, dollars, corn, anything really. There are three types of spreads, here at least. Bull spreads, bear spreads, and intermarket spreads. Okay, now in futures, we talk about a bull spread and a bear spread. A bull spread is when you buy the nearer month to expiry and sell the deferred month. That's a bull spread. Generally speaking, in most markets, not all markets, but it's called a bull spread because if the market goes up as a whole, generally the front month will lead the way. Therefore, if you've bought the front month and sold the back, you should make money out of that if the market overall is going up. Okay, does that make sense? It doesn't apply always, but that's why it's called a bull spread. A bear spread, there's no prizes for guessing this one, but it's when you sell the near month and buy the deferred. Okay, and generally speaking, again, if the overall market's going down, you'll see a widening of that spread. Or that spread should make money. Okay, so a bull spread is the opposite of a bear spread. There's no points for winning that one. Okay, but they're the two most popular types of spreads, and they are building blocks for more spreads. You may have heard about things like butterflies and condors. That's popular, and iron butterflies too. Popular strategy in options trading and in short-term interest rate trading, euro dollars and the like. Now they are simply just built using bear spreads and bull spreads. That's all that's all they are. They sound complex, and when someone tries to explain it to you, you go the first time. But all they are is a bull spread and a bear spread combined, or combinations of those. Okay, so bull spreads, bear spreads, very important to know, obviously. Now the intermarket spread is the third type of spread that we want to think about. This is a big area. Okay, but it essentially means buying in one market and selling in the other. Okay, so it does involve trading related markets, something like trading the 5-year Treasury note versus the 10-year note or the 30-year bond. That's an intermarket spread. Others would call it a yield curve spread, but it comes under that intermarket spread. Trading to stock indexes, trading the DAX versus the S&P, trading crude oil versus Brent oil, Canadian bonds versus US Treasuries, that kind of thing. They're intermarket spreads. And the key to this spread, can you trade the price of your car versus a sack of potatoes? No, you can't, because the key to it is correlation. There has to be some type of correlation. Or you can trade those, by the way, but it's not a spread trade. Okay, so what are some good inters to trade? There's a whole bunch of them, in fact. So there's in the metals, there's gold versus silver, gold versus platinum. They're correlated markets. They're both precious. They're all precious metals, but they also have different industrial uses that makes it an imperfect hedge. And that's a spread that can trend for a long time. Energy spreads. You've got crude versus Brent, different types of oil. That's a great spread to trade. You've also got what they call the crack spread, which is when if you listen to the crude oil podcast, you'll know that when they process a barrel of crude, it turns into two things, which is heating oil and gasoline. Trading those three is called the crack spread. In the meat markets also have good spreads. You've got feeder cattle, live cattle, and lean hogs, and there are trades between those as well. They can be longer term spread trades, really good ones to trade. Now, one last term before we wrap things up. I want to keep this one short, as I mentioned. Is you may have heard of exchange traded spreads. You may not have heard of it. I don't know. But an exchange traded spread is an important thing. It's not a type of spread. It's a way to go about trading spreads. When a spread is popular and it's between markets that are listed on the same exchange, then an exchange can and often does make available what they call an exchange traded spread, which means if you're trading on your depth of market on your ladder, you can call up the market for that specific spread. For example, natural gas, which is a huge spread market. You can trade the spread between January and February. You don't have to transact in January and February separately. You use the exchange traded spread of January and February, and you can see bids and offers in that spread market. So, and on the ladder, you'll see the spread price for that. You don't have to create it yourself in a chart or in your head or on a calculator, or Excel or whatever. So it's a fantastic tool that a lot of the exchanges offer, an exchange traded spread. They do it in interest rate markets, commodity markets, the whole thing. But the key ingredient is, of course, they have to be traded on the same exchange. Otherwise, it wouldn't work as a tradable product. Now, what you're doing when you do buy or sell an exchange traded spread is you are buying one and selling the other. The end result in your account are the two contracts, but it's just one click. Okay, and so that makes it great for scalping, but as well as setting limit orders and so on and not getting carried away. Other software platforms where there's no exchange traded spread available, there are software platforms. Some have an add-on, some come with it as standard, where you can build spreads yourself. It's a bit clumsier, it's a bit trickier in my opinion. That's more for custom or more complex type spreads, but those exchange traded spreads, things in grains, for example, all have exchange traded spreads, energies, exchange traded spreads, natural gas, and many other markets. Finally, before we wrap up, if you want to get more involved in spreads, take a look at masterclasstrader.com. We have an advanced spread trading class there. It covers those basics up front and then gets deeper into how you look for a spread, how you look for a trade, and how you transact in it, and so on, and building a plan around spread trading. That's the advanced spread course. Trading shorter term, there's the DOM Traders course, which will look at more yield curve and scalping type spreads. If you're interested in that, have a look at masterclasstrader.com and use the discount code TradingWithGB for 20% off. It's all one word, Trading with GB, as is Masterclass Trader, all one word, masterclasstrader.com. Signing off for now, and we'll catch up next time.